Some news from South Korea today. The government is pledging $3.5 billion from an extra budget to create 550,000 new jobs. It will also boost support to companies to try and avoid further layoffs. Now, news of that job creation plan placed the won at its highest level against the dollar in 5 weeks. But our next guest says the won's current level is still out of line with fundamentals in South Korea, and it is almost certain that South Korea is in recession this quarter. Let's go now to Daniel So. He's regional economist at Forecast. Thank you for joining us today, Daniel. Talk first about this $3.5 billion plan to create jobs in South Korea. Given all the interest rate cuts so far and the stimulus coming on the fiscal monetary side, is this the right way for the Korean government to spend this cash to create jobs, or should they be doing something else?
I think this is a right way. I would say it's a strong positive because the domestic demand is actually spiraling downwards, and they had to ease the hardship of. It's also sort of a political sensitive issue because the Lee administration just took office last February, so they have to do a lot to show that they really understand and address the need of South Korean. So this market actually anticipates such measure, employment boost, such measures. So market is not really caught surprised. The strong rally in the equity market or the won is more due to external factor.
Daniel, good morning. It's Louisa Boyerson in London. How much, though, of the opportunity do you think is just a direct reaction to the potential that the won very well could be set to rise during the second half of the year?
I see strong upside in the won. If you look at fundamentals are turning around, and the recent excessive move are a result of a speculative unwiring. I've talked to traders in the market, and they are all turning very, very bullish for the won, and there's a sizable amount of market that's been caught long, or I would say caught short in the won. So, and the fundamentals froze in terms of current, in terms of all the other perspectives are actually all turning around, and they're actually supporting the won. Right now, we are seeing the more pronounced US dollar weakness, and that's in focus right now. So I would say in the next 3 months, the won versus the dollar may reach as low as 1.249. That's what I'm looking at in the next 3 months. But of course, we may see some choppy trades now and then because market are still looking whether the rally in the world equity market can be sustained in the short term.
Daniel, it's Margaret Brennan here in the U.S. You were talking about that dollar weakness, and of course, with lending rates going down following the Fed's announcement yesterday, the immediate impact seems to be a benefit to exporters. But if you're looking at the dollar versus some of the local currencies, is that weakness going to ultimately play out to be a negative? I mean, what are you telling clients right now?
If you are looking, suppose we look at South Korea. I mean, because for South Korea, the exchange rate has been so unduly excessive. I mean, if you look at the real effective exchange rate, it has actually depreciated 31.4% since compared to when the yuan depegged in July 2005. And most Asian currency actually saw a mild appreciation of 2.3%. So depending on where the current position or competitiveness of the exchange rate itself is. So for the case of South Korea and Taiwan, I would say that even the dollar weaknesses will lead to some strength in the Asian currency, but that's not really going to dampen exports much because the currency itself is very competitive. But if you look at China, this will also give some scope for China to ease the pace of appreciation against the dollar. So the dollar weakness is actually, I would say, more beneficial to Asia exporter rather than do more benefit than harm to Asia exporter at the current environment.
Is there anything left for the central bank in Korea to do right now? They've cut by more than 300 basis points.
We are talking about in this current environment of exceptional economic distress, it's more about the quality of monetary easing move rather than the quantity. So if you look at the lending rate, it's not really dribbling down. And so I would say that they may do a pause and assess the previous impact of the previous rate cuts before they decide to do more. What I see now is more of a fiscal action in focus to mitigate the damage that's going to be done to the economy, and while waiting for the fit through of the monetary policy sometime down the road when demand return and when confidence stabilizes.
Okay, Daniel, thank you for joining us today. Daniel So, regional economist at Forecast, joining us here.